If you don't collect any metrics, you're flying blind. If you collect and focus on too many, they may be obstructing your field of view. Scott M. Graphius, consultant. Welcome to the supplement, folks. We are ploughing through the year at exactly the same speed, of course, but as always, it just seems to go faster and faster. I was reminded of a phrase this week: sell in May and go away. An old stock trader saying, because the market tends to get volatile and find reasons to go down instead of up as the summer season approaches, not as easy when your stock in trade is housing. Of course. And the reasoning, when you drill down into it, is not necessarily the most robust anyway. The same critiques would apply though. Is it the right stock? Because this measure, the units being used to short-let and take them out of the stocks, I don't believe it does under examination. The answer to the first big question is inevitably no. PD is surely a necessary evil from a local and central government perspective. Needed to get new units and prevent derelict buildings, but not helpful for the planners to determine the right mix. It seems to me days that only the bottom end and the top end really stack up particularly well for new build, more than I ever remember that happening before. Whether the units delivered bear that out, I have not researched yet. This train of thought led me to consider my pet favourite metric, inflation. I feel I might not have done enough here to right what is one of the big wrongs of the media around this in general, watching the wrong thing. I've talked very generally about inflation, but tended to discuss CPI than some of the other types which I'm going to discuss today. This is exactly the sort of reporting that I object to, so I must apologise in advance. It is the neutered metric that the government wants us to share because it sounds less bass, although you'd be right in saying, hold on, it is double figures, and it isn't in line with my average modus operandi. It's also come to my attention that I've likely made a mistake. I've confidently predicted that CPI will stay in double digits for April when the print comes out the week after next, 24th May. The consensus forecast, however, from the overall geniuses who have been getting it consistently wrong forever, but even more so over the past couple of years, is that the drop will be to 8.6%. My feeling was that the price rises from April, alongside the minimum wage and benefits increases, which themselves were pretty much in the double digits, would keep the fire burning hot. So why am I wrong and how far am I wrong? I'm going to adjust and say that CPI will still start with a 9, which would be an exceptional miss for the consensus. But let's see. What I've underpriced is what April is always a big month, particularly in inflationary times. April 22 was a significant month in price history because April and October always are energy price cap months, new benefits and pension month. April 22 was particularly aggressive for CPI, with it moving up 2.5% just from the month before, the biggest monthly figure for a long, long time. It moved CPI from 7% per 22 to 9% April 22. So that net impact upwards is not expected to be as extreme. And the base for April 23, which is April 22, had already seen a chunky price rise. Cast your mind back. energy price cap help from the government, but the price cap moved from £12.77 for the average household to £19.71 HH24%. Oil was actually fairly static in April 22. It was already very high, but of course the very recent increases, thanks to the Russian invasion of Ukraine, were seen to be working their way through to the pumps and into the shops as the second order effect took hold. So this moved the base level upwards, and the benefit of that will be felt in this month's CPI. Since petrol prices are lower today, for example, than they were in April 22. This is exactly why this week I've dedicated the image to UK core inflation compared to the US core inflation. There's been good news on this front in the US for April, as what Trading Economics, or the Walmart favorite site for the depth of data, reports the US core they're framing. Not mine. Down to 4.7%, the lowest level since December 2021. This is definitely losing pace, but interestingly is actually above the CPI in the US now, 4.6%. What this tells you is that the volatile prices have actually come down, similar to the UK fuel price in April N22 at the pumps, April N23. But the core leaves those facts out and looks at the least volatile, thus the most reliable items in the theoretical basket. We've all seen food up 20% or so in the UK, and more in certain segments, parts of the market, and we're all fairly sure that's not going to repeat in the next 12 months. It better not, and I'm 99% confident that it won't. The core tells us where we are really at. The US has seen basically a year and a half, a very elevated core, and in that interim period moved their base rate from nearly nothing to 5.25%. That's a huge change with consequences. Some seen banking sector over there, some yet to see ones of various colours, no doubt. The graph really tells you that the UK could have 6 more months before we really see a good reduction in core. Trading Economics do not report a consensus figure for core April 2023 as yet. They do, however, do a forecast, and they forecast a drop from 6.2 to 5.7. I'm inclined to make my point of order being a disagreement here, which is more significant, and suggest that number will still start with a 6. It would be lovely to think this will be back under 5 by October, but likelihood looks relatively small to me. Stubbornness is the number one trait of this sort of inflation at this point. This is the number that the central banks will be watching. It is a big win for the US from where they've been at rate, and as their governor has already pointed to, means a pause is possible. Over-enthusiastic markets are reading a pause as a pause before a drop. 5.25 is a really very precarious position for the US based on the amount of debt they carry as the deficit economy of the world, but still there's no guarantee of this. They may well carry on hiking until they really do break something simply because they feel they have to. We are a week behind. As usual, only a week. That would be nice. And so our base rate went up to 4.5% without the same guidance that we were done, or at least taking a breath. The vote is also becoming a bit boring. Anyone can forecast the 7-2 situation at the moment, with the same two doves voting against further rate rises just as they have done since base hit 3%. This is subject to change, I think, but the rise was clearly the best worst play, and that's why this time round I'd side with the 7. Even though I have no issue in disagreeing with at least a few of them on a regular basis. If you don't already see it coming. The strong likelihood is another 0.25% rise in June, the Thursday 22nd. Another date for the diary. We've got July off, and the next one, which is more of a 50-50, is scheduled for August 3rd. I'd act on that basis if you have loans tied to base rate. Surely I can wait until the rates come down a bit. I get asked, I see the logic, but this is largely FOMO thinking. If I've missed the obvious and rates are really going to crash, or if you make money by fixing last year before the trust debacle, remember that if you follow my lead here, simply reporting what I'm doing. If rates did go back to the 4% or below days, then you'd be very happy paying some of these ERCs and feeling the benefits. The bond yields are stuck in a bit of a terminal high at the moment. We'd need terrible economic data. First chance would be Tuesday in this oncoming week with employment data coming out. But I doubt there will be any particular downside surprises. Although they might be a little more disappointing than forecast, as some layoffs are bound to be minimum wage rise related. We will know quickly, but 1 month needs to be cautiously viewed anyway. I'm not waiting. And I think there could be a couple of years of treacle here before some really material falls. As I say quite regularly on this topic, there are some very clever people that disagree with me here. Then again, there's some clever people who have been predicting a property price crash since 2015, R6X, etc. And it simply hasn't happened. They missed a 25% pump in capital values if they were out of the market, simply between 20 and 22. Halifax's house price data was out, and they showed a 0.3% move downwards. They've shown appreciation since December and a mere 0.1% increase for the entire year, April 22 to 23. They also issued this in their press release. Alongside a market-wide uptick in mortgage approvals, these latest figures may indicate a more steady environment. However, cost of living concerns remain real for many households, which will likely continue to weigh on sentiment and activity. Combined with the impact of higher interest rates gradually feeding through to those remortgaging the current fixed rate deals, we should expect some further downward pressure on house prices over the course of this year. I personally see more opportunities than challenges coming out of this, and holding up the price in low value areas suits me just fine. There's surely absolute foaming at the mouth going on in the private lobbying on behalf of the major house builders at the moment as well. They've taken action, cancelling sites, pausing works, and acting in their best interests as we would expect, almost forcing the government into the next Help to Buy arrangement, which I'm sure is coming. But we must be close to some donations being cancelled, which always helps to grease the wheels. Even the more aggressive parts of the left are seeing the rental supply problem as a major issue and undergoing their favourite exercise, blame the government. The problem this time for their critics is that they are likely correct. The vast majority of the blame here does lie with the government. However, on neither side are likely to address the problem in the correct way, and there's no better background for a good old session of ideological point scoring than an incoming general election. On that subject, the Renters Reform Bill is back. Or is it? Or is it back and forth and back and forth? There's appropriate pushbacks to be considered, but I get the feeling the core of the incumbent Tory party is seeing some vote winners in there by helping the tenants are driving more landlords out of the market. Figure, as always in these situations, the ideal situation. 6 companies owning 80% all of the rental stock in the UK. That was first, not openly of course, conceptualised when George Osborne released his 2015 budget. Will not be reached overnight, and in fact is likely unviable of 20-30 year endeavour, and the interim is likely to mean a bloodbath for the poor old tenant. As always, there's lots to consider, and I could go on, but let's face it, I do that anyway. Keep your ear to the ground for those who are paying base a margin, and go ahead and get them into your pipelines to provide a solution. I've seen more deals since going 2023 than I've seen for 3 years. Enjoy it while it lasts. Standing on the sidelines waiting for a crash will mean you might be ruining the day when one doesn't happen again, despite the doomongers predicting their 19th recession of the past 7 years, and the one we did have, they didn't predict, nor did anyone else. And it saw a 25% bump in house prices, ain't Asians, totos, or framed another way, keep calm and carry on.